Hi everyone, today we'll be going over accounts May-June 2021, paper 3-2, question number 2. This is structured paper 3 which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours, which means that we will be attempting to solve each question under 30 minutes. And since question number 2 is part of section A, this deals with financial accounting. So without any further delay, let's get started. The accounting year of Y Limited ends on 31st December, and for the year ended 31st December 2019, Y Limited had the revenue of 806,400 and a non-current asset turnover of 2.10 times. Now, for the very first part of this question, we need to state how non-current asset turnover is calculated. So the formula for non-current asset turnover is sales revenue divided by the total net book value, right? Let's write it down. So that's sales revenue divided by the non-current assets. And the value recorded will be at the net book value. Alright, now for the second part, we need to explain why a company may want to know this ratio. And we can clearly see that this ratio involves sales revenue and non-current assets, which means that it helps in measuring the efficiency of non-current asset in generating the sales revenue. Let's write it down. The ratio measures the efficiency of the business in using the non-current assets to generate sales revenue. And this concludes the first part of this question. Now we can move towards the second one. We need to calculate the total net book value of non-current assets of Y Limited. Okay, we were given information regarding revenue. So the revenue amounts to 806,400, and we can see that the non-current asset turnover is of 2.10. So we will be substituting these values into our formula for non-current asset turnover and then figure out the net book value of non-current assets of Y Limited. Let's do that. So we know that the formula is sales revenue divided by the non-current asset, and we are given the sales revenue of the value 806,400. So we need to divide it by the non-current asset. And this is the net book value. And we are also told that the non-current asset turnover ratio is 2.10 times. Now we can easily figure out the non-current asset at its net book value. That's just going to be revenue of 806,400 divided by 2.10, which results in the net book value of the non-current assets to be 384,000. This concludes the second part of this question. Now we can move towards the third one. We are given additional information. Y Limited classifies non-current assets into 3 categories, and the accumulated depreciation at 31st December 2019 for each category was: for property, it was 128,000, for plant and equipment, it was 168,800, and for furniture and fixtures, we can see it is 101,200. Now, the net book values of the 3 categories at 31st December 2019 were in the proportion of 5:3:2. Alright, and we already figured out the total net book value of the non-current assets, right? So we just need to divide this on this particular ratio in order to figure out the net book value for property, plant, as well as equipment. Let's have a look above. We figured out the total non-current assets net book value to be 384,000. Let's divide this. So that's the total of 384,000. And for property, we can see that out of 10 parts, 5 parts belongs to it, right? So the net book value is just going to be the total of 384,000 times 5 out of 10, right? Which gives the net book value of property at 31st December 2019 to be 192,000. Now we repeat the same process for plant and equipment. That's the total of 384,000. And according to the ratio, 3 parts out of 10 parts belongs to it. So that's times 3 by 10, which results in its net book value at 31st December 2019 to be 115,200. Now for furniture and fixtures, that's the total of 384,000. And according to the proportion, 2 parts out of 10 parts belongs to it. So that's times 2 by 10, which results in its net book value to be 76,800. Okay. Then the following information relates to the accounting year ended 31st December 2020. On 1st January 2020, the property was revalued at 360,000. Okay. And on 1st March 2020, the office furniture was purchased at the cost of 25,000. Then on 1st July 2020, an item of old equipment was part exchanged for a new item. Y Limited paid cash 34,000 as a part payment for the new item, and the old item had an original cost of 35,000 and was fully depreciated. Its part exchange value was 8,000. So let's figure out the cost of the new equipment. That is just going to be the cash payment as well as the part exchange value. And we can see that Y Limited paid cash 34,000. So that's 34,000 plus the part exchange value, and the part exchange value was given to be 8,000. So this gives the cost for new equipment to be 42,000. All right, then a full year's depreciation is charged at the year of purchase and none in the year of sale. Non-current assets are depreciated as follows. Property is to be depreciated using the straight line method over 20 years. We have plant and equipment 20% per annum reducing balance method, and for furniture and fixtures 20% per annum straight line method. Okay, let's have a look at our third question. We now need to prepare the non-current assets schedule to use as a note to the financial statements for the year ended 31st December 2020. Okay, for non-current assets schedule, we have 3 sections. The first one deals with cost, the second one deals with depreciation, and the third one deals with net book value. So I'm just going to write down all of those 3 sections and then fill in the values later. So the first section relates to cost. And since we have the year end of 31st December 2020, the opening date would that be of 1st January 2020, right? So we start with the opening cost. That's at 1st January 2020. Then we include all of revaluation, new addition or new purchases, any disposals, and this gives the cost at our ending date, which is 31st December 2020. Okay, that's for property, for plant and equipment, for furniture and fixtures, as well as the total. And this concludes the first section. Then the second section deals with depreciation. And again, we start with the opening balance, which is at 1st January 2020. And this actually means the accumulated depreciation at this date, right? And then we have to adjust the revaluation, because whenever assets are being revalued, all of its previous accumulated depreciation should be cancelled, right? So we need to adjust it. Then we need to adjust the disposals as well, because whenever we're disposing the assets, we need to get rid of its accumulated depreciation as well. Then lastly, we have the depreciation charge for this year, because this should definitely be included in our accumulated depreciation value. And this gives the depreciation value at the closing date, which is at 31st December 2020. Okay. And the third section would be that of net book value. And net book value is just going to be at 2 different dates. So it's going to be at 1st January 2020 and at the closing date of 31st December 2020. Okay, so this is the format for the schedule of non-current assets. Now we begin by filling in all of the values. Let's have a look above. So the very first thing that we were given is the accumulated depreciation at 31st December 2019, which is basically the opening date of 1st January 2020, right? So we need to write down these 3 values as our opening for the depreciation section. So that's 128,000, 168,800, and 101,200. Let's write it down. So for property, it was 128,000. For plant and equipment, it was 168,800. And for furniture and fixtures, it was 101,200. Now we need to add all of these in order to figure out the value for the total. That's 128,000 plus 168,800 plus 101,200, which results in the total accumulated depreciation at 1st January 2020 to be 398,000. Okay. Now we were given the net book values information, and we already figured out the net book value at 31st December 2019, which again means that this is the net book value at the opening date. So we need to record these three values of 192,000, 115,200 and 76,800 as the net book value at the beginning date. Let's write it down. Okay, so that's 192,000 for property. Then for plant and equipment, we had 115,200. And finally, for furniture and fixtures, we figured it out to be 76,800. Now for total, we just need to add these three values, 192,000 plus 115,200 plus 76,800, which results in the total to be 384,000. Okay, we can see that we have our depreciation as well as the net book value at the opening date, which means that we can easily figure out the cost for the opening date, because cost is just the sum of the accumulated depreciation and the net book value, right? So we can easily figure it out. Now for property, that's going to be the accumulated depreciation of 128,000 plus the net book value of 192,000, which gives the cost at the opening date to have the value of 320,000. Now we repeat the same process for plant and equipment. We have the opening accumulated depreciation of 168,800 and we have the net book value of 115,200, which gives its cost to be 284,000. And now for furniture and fixtures, we have the accumulated depreciation of 101,200 and we have the net book value of 76,800, which results in its cost to be 178,000. Now for the total, that's going to be the sum of these three values, which is 320,000 plus 284,000 plus 178,000, which results in the value of 782,000. Okay, now let's have a look above again. On 1st January 2020, the property was revalued at 360,000. Okay, and we can see that its actual cost was 320,000 and now we are revaluing it to 360,000, which means that there is definitely revaluation upwards. Let's figure out the revaluation amounts. That's 360,000 minus 320,000, which results in the revaluation amount to be 40,000. So we need to record this amount under revaluation right here. So that's going to be 40,000 for property. And like I said before, whenever we revalue assets, all of its previous accumulated depreciation should now be discarded. And here we can see that the previous accumulated depreciation for property amounted to 128,000 and we need to discard it. So I'm just going to subtract it so that now the accumulated depreciation for property would be 0. That's 128,000, but in a bracket, indicating that this needs to be subtracted. Okay, now we can move towards another information. On 1st March 2020, office furniture was purchased at the cost of 25,000. So this is the new additions for furniture and fixtures. Let's write it down. Let's have a look above. And we were told that on 1st July 2020, an item of old equipment was part exchanged for new item. And we can see that the cost of the new item was 42,000. So let's record this in additions in the cost section. So that's additions for plant and equipment of 42,000. But we also know that we part exchanged an old equipment, right? So we need to subtract that disposed equipment's cost in the cost section. So that's 35,000 cost of the old item, right? So we need to subtract this under disposals. So that's going to be 35,000. And we know that whenever we are disposing assets, we also need to dispose all of its accumulated depreciation. So we need to subtract its accumulated depreciation as well, right? Let's have a look above. We were told that the old item had an original cost of 35,000 and was fully depreciated. So whenever an item is fully depreciated, it just means that its cost will be its accumulated depreciation. So the accumulated depreciation will also amount to 35,000, right? So we need to subtract this accumulated depreciation in our depreciation section. So that was for plant and equipment, and we are just disposals right here. So we need to subtract its accumulated depreciation of 35,000. Okay, so for cost, we included everything. Now let's figure out the total. For revaluation, that is just 40,000. For additions, that's 42,000 plus 25,000, which results in the value of 67,000. And for disposals, we only disposed plant and equipment amounting to 35,000. Now we can figure out the cost at 31st December 2020. For property, that's going to be the sum of these two amounts, 320,000 plus 40,000, which results in the value of 360,000. For plant and equipment, that's the sum of these three amounts, 284,000 plus 42,000 minus 35,000, which results in 291,000. For furniture and fixtures, that's going to be the sum of these two amounts, 178,000 plus 25,000, which results in the value of 203,000. And for total, that's going to be the sum of these four amounts, 782,000 plus 40,000 plus 67,000 minus 35,000, which results in 854,000. Okay, now we move towards our depreciation section. We already adjusted the revalued assets depreciation as well as the disposed assets depreciation, right? So we just need to figure out the depreciation charge for this year for property, plant and equipment, and furniture and fixtures. All right, so let's have a look above. We are told that a full year's depreciation is charged in the year of purchase and none in the year of sale. So whatever assets we dispose of, we do not need to charge its depreciation, but we need to charge a full year's depreciation for any new additions. Now we'll start with property, and property is being depreciated over 20 years under the straight line method. All right, and we can also see that our value for property is 360,000. But this is the revalued amount. Previously, we had the cost of 320,000, and out of this, 128,000 had already been depreciated. So now we need to figure out the percentage of the remaining value, or the net book value, right? Let's figure it out. So that's going to be the cost of 320,000. And out of this value, 128,000 was already depreciated. So we need to subtract this. And we need to figure out its ratio. So that's 320,000 again, times 100%, and this gives the percentage of the property still not depreciated to be 320,000 minus 128,000 divided by 320,000 times 100%, which is 60%. So out of the total cost of 320,000, 60% is yet to be depreciated. So it means that for 20 years, we still have 60% of these years remaining. So let's figure out the actual remaining years. That's just 60% of 20 years, right? So that's 20 times 60%, which you can write down as 0.60. And this gives the remaining years to be 12. So we need to charge depreciation for 12 years now. So let's charge it. The depreciation charge for property is going to be, now we charge the depreciation on the new revalued amount, which is 360,000, right? So we just need to divide 360,000 among 12 years. And that gives the annual depreciation charge to be 30,000. Let's record this as the charge for the year in our depreciation section. That's 30,000. Now we move towards figuring out the depreciation for plant and equipment. And we were told that for plant and equipment, we depreciate it at 20% per annum, reducing balance method, which means that we charge this rate of 20% to our net book value rather than the cost. So let's figure it out. That's going to be plant and equipment. And we already figured out the cost at the ending date, right? Which is right here. So that's 291,000. Now we just need to subtract the accumulated depreciation in order to figure out its net book value. But we can see that for accumulated depreciation, previously we had 168,800, but we subtracted the value of 35,000 as the accumulated depreciation for disposed plant and equipment, right? So the actual accumulated depreciation would be 168,800 minus 35,000, because we no longer need to include the accumulated depreciation of disposed plant and equipment, right? So now we need to charge the rate to this value, which is the net book value, and the rate was 20%, so we can write down as 0.20. So this gives the annual depreciation charge on plant and equipment to be 291,000 minus 168,800 minus 35,000 times 0.20, which results in the value of 31,440. And we need to record this in our schedule of non-current assets. Let's write it down. That's 31,440. Now we also need to figure out the depreciation for furniture and fixtures, and we are told that it is being depreciated at 20% per annum using straight line method, which means that this depreciation rate is to be charged at its cost, right? And we already figured out the cost. So that's for furniture and fixtures. And the cost at the ending date is 203,000. So we just need to charge our rate to this value. That's 203,000 times 20%. And this gives the annual depreciation on furniture and fixtures to be 40,600. Let's record this. Okay, so we have now completed the accumulated depreciation section. So we can write down the total. For revaluation, that's 128,000 negative. For disposals, that's 35,000 negative. And for the charge for the year, that's 30,000 plus 31,440 plus 40,600, which results in the value of 102,040. Now we can easily figure out the accumulated depreciation at the closing date. For property, that's going to be the sum of these three amounts, 128,000 minus 128,000 plus 30,000, which results in 30,000. For plant and equipment, that's the sum of these three amounts, so that's 168,800 minus 35,000 plus 31,440, which results in the accumulated depreciation to be 165,240. For furniture and fixtures, that's the sum of these two amounts, 101,200 plus 40,600, which results in 141,800. And for totals, that's the sum of these four amounts, 398,000 minus 128,000 minus 35,000 plus 102,040, which results in the value of 337,040. Okay, now we can easily figure out the net book value at the closing date, since we know that net book value is just the cost minus accumulated depreciation. Okay, for property, we have our total cost at the ending date of 360,000 and the accumulated depreciation is 30,000. So the net book value at the ending date would be 360,000 minus 30,000, which results in the value of 330,000. Now we repeat the same process for plant and equipment. That's the cost of 291,000 minus the accumulated depreciation of 165,240, which results in the net book value to be 125,760. And for furniture and fixtures, we have the cost of 203,000 minus the accumulated depreciation of 141,800, which results in the net book value to be 61,200. Now, the total would be the sum of these three values. That's 330,000 plus 125,760 plus 61,200, which results in the total for the net book value at the closing date to be 516,960. This concludes our non-current assets schedule, as well as the third part of this question. Now we can move towards the fourth one. Okay, we were given the working section, so instead of scribbling all over the question paper like I did, you guys should be showing all of your workings in this particular box. We are given additional information. The directors plan to buy new motor vehicles in 2021. We need to explain to the directors why they need to depreciate motor vehicles. So the very first one is because motor vehicles is non-current asset, right? So this obviously needs to be depreciated, and depreciation is important to be recorded because it recognizes the loss of value of non-current asset over its useful life, right? So let's write this down. So the first one was that motor vehicles are non-current assets, and we need to charge depreciation to our non-current assets. And the second reason was because depreciation recognizes the loss of value of non-current assets. So depreciation recognizes the loss of value of non-current asset over its useful life. And we need to charge depreciation because it is in compliance with our matching concept as well as the prudence concept, right? Because matching concept states that we need to match the cost of the non-current assets with the revenue generated, and the prudence concept states that the value of non-current assets should not be overstated. Let's write this down. So depreciation is in compliance with matching concept and prudence concept. Okay, and the depreciation is also a requirement of IAS 16. So that could be another reason, requirement of IAS 16. Okay, this concludes the fourth part of this question. Now we can move towards the fifth one. We now need to explain to the directors the impact on profit of using each of the straight line and the reducing balance method of depreciation. Okay, let's start with straight line. We know that in straight line method of depreciation, the depreciation charge for each year remain same, right? So let's write it down. The charge against the profit, because we charge depreciation and subtract it in order to figure out the profit, right, is constant each year. And this is constant because on the straight line method we charge the rate to the cost, right? And cost does not change over years. So since this remains constant, the entire value also remains constant. And we charge straight line under the assumption that the non-current asset is used up evenly throughout its useful life. Let's write it down as well. Because it assumes that the non-current asset is used evenly throughout its useful life. Now let's move towards reducing balance. And under reducing balance method of depreciation, we know that the rate is being applied to the net book value, right? And we know that the net book value decreases each year because obviously the accumulated depreciation increases each year, which in turn results in the decrement of net book value. So the total depreciation amount will also decrease over the years. Let's write it down. The charge against profit is higher in early years and lower in later years. And this is due to the fact that reducing balance method assumes that the non-current asset is used up more in early years than the later years. Let's write it down as well. Because it assumes that the non-current assets is used up more in the early years than the later years. Alright, this concludes the fifth part of this question as well as the entire question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you subscribe to this channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.